Welcome to TaxLink's latest webinar. Today we're looking at issues in citizenship-based taxation in the US and beyond. And I'm excited to say that we received so many questions that we're going to host a second session in about 3 weeks. So stay tuned for that, and you'll get a chance to register for that one too. So whatever questions we have left over from today, we will tackle on June 24th. Same time, same place, okay? So just want to let you know. Let me get some admin issues out of the way before we get started. I will not be moderating this session. Our good friend John Richardson will be in charge of leading the discussion and introducing our panelists, etc. If you have any questions for our panelists as you listen to what they have to say, make sure to use the GoToWebinar control panel. Submit the question there, and I will make sure to forward them to John, to Leonard, and to Karen, and they can tackle it. Also, if you're a TaxLink member, you're eligible to receive a 1 CPD credit for this for attending this event. Just make sure you're paying attention, because the system can track whether you're paying attention or not. If you're not paying attention, then we cannot give you those credits. So without further ado, I'm gonna pass on the mic to John, who's going to take it from here. Thank you very much, and have a great webinar. I'll be with you guys back in a bit. Thanks.
Okay, thanks very much, Matteo. Actually, can we get confirmation? When I got the notice, it said 2 hours, but I thought this was 1 hour. Are we 1 hour or 2 hours today?
It's 1 hour.
1 hour. Okay, thanks very much. Okay, so for those of you who don't know me, my name is John Richardson. I live in Canada. I'm a Toronto-based lawyer. I think very quickly, if I could ask Leonard and Karen to introduce themselves. Leonard?
Yes, my name is Leonard Tuber, and I'm a tax manager in Israel for a firm that is called Abu Alafia. We are an international tax firm. We do, of course, Israeli taxation and auditing, but also US, UK, and French taxation.
And you're an accounting, you're CPAs, are you?
No, I'm licensed as an enrolled agent, but I have a degree in accounting from a US university.
Okay.
I've been practicing my entire professional career in Israel. I came to Israel as a teenager, went back to school to go to college, and came back here and started practicing almost right after graduating school. So I have an EA credential. And I've been working in international taxation my entire career here in Israel.
Okay, I think it might be a good moment before we ask Karen to introduce herself. One of the issues here with compliance is, of course, who does a prospective person to, approach? And I'm wondering if you could briefly explain the difference in a little greater clarity between an enrolled agent and a CPA.
Okay, an enrolled agent, our credentials come directly from the IRS as opposed to a state accrediting agency such as the New York State Board of Certified Public Accountants. We have the same unrestricted practice rights in the area of taxation as a certified public accountant. However, we cannot audit financial statements, but we can represent taxpayers in front of every department within the IRS. It's a very good accreditation for international practitioner because we're not limited to a state.
Mm-hmm. Okay, interesting. And since we've gone this far in the discussion, could you explain to our listeners what Circular 230 is and how it, in a sense, provides a regulatory framework for you?
Circular 2, they're basically the ethical standards of which tax practitioners have to abide by. I believe that would be the best general description of Circular 230. And so that's essentially it. As practitioners, we have certain not only legal but ethical responsibilities, and Circular 230 does the best that it can to define what those are. And all enrolled agent, CPAs, anyone who is engaged in U.S. tax preparation, if, of course, bound to Circular 230.
Okay, and would that include just a base tax preparer? For example, just for the benefit of, this mass of people who are trying to get into compliance. So we've got.
I believe that any federal authorized tax preparer, and there are different levels today, are bound by Circular 230.
Okay. Now, Karen, continuing on, as well as introducing yourself, you either are or were, you at one time were an active CPA, I think. Is that
At one time I was, yeah. But, so when I finished my master's degree, I went for work with one of the big firms as a tax professional, worked my way up to tax manager, and then left to go on to other pursuits. So I have a background in tax. I did get a master's in tax at University of Southern California back in the 80s when I was doing tax. It's been 30 years now since I was an active tax preparer, but I do have a bit of a background in that part of the law. In 1995, we moved to Australia, and so I've been in Australia since. It was not feasible to try and resurrect my CPA, so I went the academic route once I got to Australia. Got myself a PhD in finance at the University of Queensland, which is where I'm currently a lecturer in finance. But my research covers the tax effects of all sorts of things in finance. And recently I've been spending a lot of time looking at citizenship-based taxation and how it affects US expats, especially in Australia.
Right, and doing a fabulous job of it as well, I might add. A great contribution to the discussion. So if we look at the issue of, who somebody might go to get taxes done, right? We have lawyers. I'm a lawyer, but I would not come to a lawyer to get your taxes done. Okay, period. We would have an enrolled agent, which Leonard would be an example of. We have the CPAs, for whom tax is one sort of specialty, which Karen either was or is or whatever. And then we have, I'm going to use the H&R Block type. These are tax preparers without any, they would perhaps pass a test administered by H&R Block, but they would not be, they wouldn't have any independent sort of validation or something like that. And all of these people, when you approach them, come with certain rules that they presumptively have to abide by, like the Circular 230. Now, moving on here. Now, Karen, a moment ago, you said that, you're spending a lot of time with your research in relation to citizenship-based taxation. I noticed that the title of this webinar is Citizenship-Based Taxation. But personally, I think that's a bad description of what's going on here. And I think we might want to start with, what are we actually talking about here? Karen, let's start with you. Is citizenship-based taxation a very descriptive way of describing what we're here to talk about today?
Well, it's really more the taxation of citizens who aren't living in your country, because the US taxes residents regardless of their citizenship. But it's only the citizens who live outside of the country that it claims the jurisdiction to tax solely because of their citizenship, even though they are tax resident elsewhere.
So would you say then that perhaps a more accurate description of this might be non-resident taxation rather than citizenship taxation?
Worldwide taxation of non-residents.
Worldwide taxation of non-residents in the US.
In other words, taxing not just based on source. So just about every country will tax non-residents on income sourced within that country.
Mm-hmm.
The US will do the same whether you're a citizen or not. The question is what the US does with your non-US source income when you're not a US resident.
Right. So, Leonard, would you then agree with this, just expanding this a little bit, that what we're really talking about here is the rather unique U.S. practice of imposing worldwide taxation according to U.S. tax rules on people who are actually tax residents of other countries. Would you agree with that?
I would agree with that description, yes.
Do you think that's a more descriptive description, a better description than just sort of citizenship-based taxation?
Well, one, you would have to be a citizen of the U.S. to be subject to worldwide taxation. That is the first qualification. When you go beyond that, of course, you have the issues of the U.S. taxing its citizens who reside and are tax residents outside of the United States on foreign source income. Which many countries do not even tax. Israel, up until very recently, at least in historical terms, did not always tax its residents on income that was generated outside of Israel. So it's a full inclusive tax system. Certainly, the U.S. will tax its residents regardless of where they live, on income from all sources, taking into account certain mechanisms under both domestic tax law and treaty to try to mitigate double taxation.
Okay, so to put this, to give a very visual sort of example, what we're talking about here today is we'll take somebody in, say, Israel or Australia who happens to have been born in the United States, and we'll start from the premise that they're already living in Australia or Israel and paying tax according to U.S. tax rules in Israel. So their income earned in Israel is subject to direct taxation by the United States, even though they don't live in the United States. We've got that right?
Correct.
Okay. Now, there are a lot of people in the world, who really just don't seem to understand exactly what is the problem of the United States imposing worldwide taxation on people who don't live in the United States. But they, of course, have never experienced things like CFC rules, PFAC, phantom capital gains, and what over the last 10 years, in my view, has simply become escalating examples of what I'm going to call fake income, right? Income that's taxed with any kind of a realization event. All right, would I get any pushback on that?
I agree with you. Income that has not been constructively received, and sort of like the fundamental principle of at least domestic tax law in the U.S. is that income is taxed when it is constructively received. When you look at the anti-deferral regime that affect U.S. citizens living outside of the United States, the PFIC regimes that you've mentioned, Subpart F income, the various CFC regimes, they are taxing income at the individual level, which is not constructively received, which in my mind is a very big departure from one of the very fundamental premises of just the equitability of U.S. taxation.
Okay.
They can
So in
tax
other words,
income that someone will not, hasn't received. They haven't brought it into their pocket. It's overreaching in that, or overreaching that's subject to debate. But it's what we've seen over the last decade has been a very far-reaching attempt to just immediately repatriate income into the U.S. tax system.
I find the term repatriate kind of amusing when you think about somebody who's, living in Australia, all their life is in Australia, and you're going to repatriate their income to the U.S.?
Well, that's exactly right.
That's what they call 965, a repatriation tax.
I know they
kind
did.
of borrowing the terminology here.
Well, maybe by using the word repatriate, they're trying to make it seem like it's patriotic. But one of the problems with, having these sort of abstract discussions is I think it obscures what's going on. Isn't a better way to put it that what these rules do is make up income the person never received that's sourced from another country and simply steal that money out of the other country? Isn't that a better way to put it?
Well, there were some adjectives that you used there that I don't know if I would use, but it definitely is.
For example, what?
Well, I mean, stealing income. I don't know if it's stealing income. I do think that one has to have a legal right to income. I mean, you definitely have to be the shareholder of the CFC. You have to be the beneficial owner of that income. There are timing differences. Once you agree with the general principle of citizen-based taxation, and that's for another discussion, then the question really becomes to the extent in which income recognition can be deferred. And I certainly think that the U.S. has gone to extremes in that respect, as far as when they have the right to tax income. In the US, for instance, under the normal corporate structure, someone owns a corporation, the individual is not taxed until there's a distribution, until that income has been constructively received, distributed out of the company and into the individual taxpayer's pocket. Today, that is not the case.
See, and for active business income, that's how it was with CFCs even before the Tax Cuts and Jobs Act, right? I mean,
under subpart F, yeah, but that generally target only passive sorts of income. Now
right.
Under GILTI, they're going under active business income.
That's right.
Again, they're taking things to extremes here.
So it's impossible to run a business as a U.S. expat now.
It's becoming much more difficult, even for accountants that have their own corporations. Yes.
So what that does then is, if you can't run your business, you can't hire any employees, and it's the Israeli economy that hurts, not the U.S. economy. So these U.S. tax rules are affecting the host economies.
Certainly, it's very difficult for Americans living in Israel, and I'm sure other countries, what's the best entity in which to do business in Israel. On the one hand, you have, for instance, there's kind of a double-edged sword here. If you're self-employed in Israel, you're subject to self-employment tax in the United States, and the U.S.-Israel tax.
That's a great point you raised. And can I just get you to pause there and elaborate on that a minute? Because one of the things that I find interesting, my world is, more Canada and perhaps the UK, but I am aware that Israel does not have a totalization agreement. Have I got that right?
That is correct.
And that is a problem. Exactly why. Compare the situation for a self-employed individual in, say, Canada that does have a totalization agreement.
Or Australia, we have one.
Or Australia, which has one too. Your country, Israel, which does not. Why does this exacerbate the problem?
It exacerbates the problem in the way when there's a self-employment income is essentially Social Security. If you're a self-employed individual, you're paying both the employer and the employer and employee portion of Social Security. Social Security is money you put away for your retirement. Now, if you're living in Switzerland or Canada or Australia, you're subject to the Social Security system within your country. Totalization agreements say if you pay into the Social Security system in the country in which you're a resident, you do not have to pay into the U.S. tax system.
In other words, you don't pay the self-employment tax.
Correct. You don't pay self-employment.
What's the percentage rate of the self-employment tax? What is that?
13.5 currently. Now, let's say you're a sole proprietor here in Israel. You're an accountant and you didn't incorporate. You work for yourself. You just put out a shingle and you work for yourself. Now, your income can be excluded under the foreign earned income exclusion, or by the utilization of foreign tax credits. So you're not paying income tax to the United States, but there is a separate layer of tax called Social Security tax, that self-employment tax, which you do have to pay in, and it's not eligible to be offset by the self-employment tax that you pay in Israel or by any foreign tax credits. So you're paying into a social security system that you may not ever, you may not ever receive those benefits. So in the past, a very simple planning technique was to tell people to incorporate, and you would simply take a salary out of your own company. If you're a salaried employee, you're not subject to self-employment tax. But now, of course, under GILTI, they're going to tax your corporate earnings, So there's really very few things, if any, that a U.S. citizen can do in Israel to effectively do business. If they're self-employed, they're going to pay self-employment tax. And if they operate under a corporate entity, they essentially are going to have to drain somehow, currently under GILTI, all of the income from the corporation, or they're going to be taxed before they've actually received money in their pocket. Israel is not going to impose a tax on corporate earnings that have not been distributed. So you have a tax liability now to the US without any offsetting foreign tax credits, and it's just a mess. It does result in literally double taxation, I believe, in many respects.
So the message for an American citizen in Israel would be something like this. You should have bumper stickers saying, "I'm American, I'm not self-employed."
That could be, yes.
Okay, that was a very interesting answer, which I think provides a segue into one of the group questions had to do with the foreign earned income exclusion, the difference between the foreign earned income exclusion and the foreign tax credit regime, and this sort of stuff. Karen, I'm going to ask you to discuss the foreign earned income exclusion, but with an emphasis on the following slant, okay? There's a perception in the United States, particularly, that the way the foreign earned income exclusion allows an American citizen to simply exclude $100,000 of income every year. So what's the problem exactly?
Yeah, well, so the problem is that not all of your income is earned. So the foreign earned income exclusion is only good for earned income. So if you are living in Australia or wherever while you're employed, no problem, you've got a foreign earned income exclusion, but at some point you're going to retire. And when you retire, your income is going to be not earned because you're not earning anything anymore. So the foreign earned income exclusion completely evaporates for unearned income, number one. And in fact, in Australia, I think very few people actually use the foreign earned income exclusion, because unless your income is, between 12 and 20,000, about there, you might find the earned income exclusion useful, because you're not paying hardly any Australian tax, at that level. But once you get above about 20, 25,000, you're paying way more in Australian tax than you would be paying in US tax. So the foreign tax credit works better, because with that, you're allowed to carry the credits forward for 10 years. And especially if you're nearing retirement, those credits might possibly, depending on how your retirement income comes out and what category, FTC category it's in, but that might possibly allow you to offset some of the US tax on your retirement income after you retire.
All right.
So the foreign earned income exclusion doesn't fix everything, because not all income is earned.
Okay, so it applies only to earned income, and without getting overly technical, earned income should be thought of as salary, employment income, and gross income from self-employment. Is that correct?
Yeah.
Okay.
Yeah.
Now, the interestingly, you both point out that one could, in limited circumstances, use the foreign earned income exclusion. And that is an exclusion. It's though there's no income to tax, period. Okay. But let's now extend this over to the foreign tax credit rules, because I think those need to be seen a little bit differently. You do owe U.S. tax because the income is included. It's just that the mechanism to pay the U.S. tax is tax you pay on that income in another country. Would you agree with that definition, Leonard?
Yes, you can offset your U.S. tax liability by taxes paid within your country of tax residence. So if you owe $100 in U.S. tax, but you've paid $100 of tax on the same category of income in your country of residence, then you end up having a zero tax liability. It remedies double taxation in that.
And possibly the excess can be carried forward for what, 10 years, is it?
Yes, the excess can be carried forward. However, with GILTI, they've created a separate foreign tax basket, if you will, for GILTI, which was, so you can't offset any taxes, whatever that you've put within your GILTI foreign tax basket cannot be used to offset earned income or passive income as well. So it categorizes.
There's no carryover of that either, is there?
With GILTI, is there a carryover for GILTI taxes paid? I'm not sure.
Karen?
No, there's no carryover.
I don't believe so, but one would have to make, I believe, an election, a 962 election. There's a problem. How does an individual get an indirect foreign tax credit, which could be a subject for another webinar?
We have done them. We have done them. The 962 election, yeah.
Yes, yeah.
Okay, so this is interesting, because somebody from another planet or from the United States, that is living in the United States, I don't mean they're the same, but meaning I think somebody who had no real firsthand experience of the effect of this type of stuff, might say, well, how can there be a problem? I mean, you just explained how people living outside the United States are unlikely to actually pay any U.S. tax. They remove it with a foreign earned income exclusion, or if they can't do that, then they use foreign tax credits and that.
That's fine if you have a really simple life. If you have a really simple life, you're working for an employer and you're not saving for your retirement and you're just living hand to mouth, week to week or whatever, then it's no problem.
But isn't that how an American should live?
The minute you try to start saving for your retirement, running a business, investing, any of those things, then you run into problems.
Mm-hmm. And that's without even considering the whole anti-deferral problems, right?
Yeah, well, that's another layer of problems.
Well, I mean, actually, one thing, before we leave the whole foreign tax credit thing is, am I right or wrong when I say under the Internal Revenue Code that the Obama 3.8% healthcare tax cannot be offset with foreign tax credits? Am I right on that?
You're correct.
That's what I was afraid of.
Net investment tax cannot be, and it really has essentially, I've seen how that has destroyed savings for people here in Israel.
Destroyed?
It's destroyed savings.
That's a strong word for you, Leonard.
Now you have, people are essentially dividends that people are taking on investment incomes that they then want to reinvest for their retirement, for their savings. Gone. You're paying 3.8% on that. It cannot be offset by any foreign tax credits. It's probably a redistribution of wealth that I think we haven't seen historically in decades, maybe.
Well,
So
I mean, don't
again,
you?
it's the U.S. stealing out of other economies, right?
Well, Leonard doesn't like that word. Are you warming up to the word now so far? The word stealing,
Yeah, well, yeah.
maybe.
Let's put it this way. I definitely think that it's you know,
Are there
it's
some
overreaching.
improprieties going on here?
It's certainly overreaching, especially again like self-employment tax. How many people living their entire lives outside of the United States are ever going to be recipients of Medicaid or anything like that?
It is quite extraordinary that this thing is set up so that people in other countries are actually funding health care for homelanders, that they themselves can't take advantage of. It's not a bad idea. I mean, maybe other countries should take the example of the United States. Let residents of other countries fund your healthcare system. Not a bad idea.
And before we leave the foreign tax credit discussion, when you're dealing with investment income such as long-term capital gain, qualified dividends, the actual preferable tax treatment that is meant to encourage people to save money for their retirement. Much of that under, for instance, the foreign tax rules, when you take into the account the long-term capital gain rate differential adjustments, just the math involved in calculating your foreign tax credit, a very big percentage of your foreign passive income isn't even eligible for tax credits to begin with.
Now, that is a very important point. And if I can just sort of pause here and generalize that a little bit, okay? One of the ongoing problems, well, there are so many problems with this foreign tax credit stuff, including the number of categories, but, one of the ongoing problems is that, there are plenty of taxes that people pay in their country of residence that, because they don't meet the definition of that kind of U.S. income, cannot be used to offset, as a tax credit, U.S. taxes. And we see this, this all the time. Okay. So it's pretty clear, right? It is pretty clear just from this sort of 15-minute round table we've been having that anybody who makes the claim that somehow the foreign earned income exclusion, the foreign tax credit rules solve the problems of Americans abroad really doesn't have a clue what they're talking about. Would you agree?
I would certainly agree with that statement, yes.
Okay, so anybody from the United States who's listening, there's your proof, okay? I mean, I think this is a gigantic problem, and I think that it's a gigantic problem in trying to get these laws changed, is that it is so complicated. I mean, both of you are, superstars in this area, but, one of the prerequisites of being a superstar in the area is you have to have spent, I think, an ungodly number of years thinking about this stuff. Would you agree?
Yeah.
I mean, it's just not the kind of thing, where, the way this, if the stuff is covered in enrolled agent courses or, it's just not, there's just no time to really learn it. So we have this problem, even if the income is actually realized. And now we've got this whole layer of, what I think of as just fake income, which flows from the anti-deferral regime. And I would argue that even the PFIC rules are fake income because of the redistributing the income over years that income was never received, right? I mean, that's fake income.
And add to that the currency fluctuation income. Because, I do my life is all in Australian dollars, but I have to, when I was doing US returns, I had to do them in US dollars as if everything I bought was bought with US dollars.
Well, I mean, just last week I was working with somebody and, he thought that he had a $200,000 capital. I'm not making this up. He thought he had a $200,000 capital loss. It turned out on the U.S. return he had a gain. I've never seen anything as an example as egregious as that. but this shows you how, these exchange rate shifts can, create real problems,
That's a very interesting example. I saw an example of that this week.
You too?
Yeah, yes.
As bad as that?
As bad as that due to exchange rate differences, someone who had a loss here in Israel on the sale of property, he had ended up having a U.S. capital gain.
Incredible stuff. So, an American who leaves the United States is tied to the U.S. dollar.
Well, and to add to that currency thing, the whole thing about mortgage indebtedness with a currency shift, because really when you think about it economically, you buy a house, you put a mortgage on it. Those are, if you were working in US dollars, that's a natural hedge. But the US, if it's your principal residence, the US denies you the loss on the loss side of the hedge and is going to recognize the income on the income side of the hedge.
Yeah. The more I learn about this, and I think that, I think that we all would agree that the best you can ever be of this, we're all permanent students.
I'm sorry.
Yeah, okay. We're all permanent students of this. I mean, this is not something where, you sort of take a course and after 30 days, I know this stuff. We're all permanent students. And one of the reasons that we're permanent students is, we've been having this discussion about the Internal Revenue Code, but we've got now these treaty overlays, right? And one of the things I'd like to talk about in relation to the treaties, and that which will provide a nice segue into some other things, is this business of the saving clause. Karen, what you want to tell us what the saving clause is and why it's a problem, and how perhaps changes in the tax treaty could be a help?
Yeah, so the savings clause basically says that the U.S. inserts this in every treaty they write, basically, and it basically says that if you're a U.S. citizen, the treaty doesn't count except for these really small list of enumerated sections of the treaty that you can use as a U.S. citizen.
Does it help for the double taxation?
No, it doesn't help for double taxation.
I agree with you. I think that's the right answer, because the ones that I haven't looked at all of these, but if you look at the Canada-U.S. one, it says that they'll provide tax relief from double taxation, I think, to the extent that U.S. law allows it.
Yeah. Yeah, usually the no double taxation article of the treaty is one of the things that's exempted from the savings clause. But even so, there's a lot of things that you can't use. So in the Australian treaty, the whole pensions article, the only thing you can use is the Social Security clause in that article. So the rest of it, if you're a U.S. citizen, you can't use.
Yeah, of course. In Australia, the situation is absolutely horrendous because, we've talked about this many times. The whole issue of the superannuation, right. And the U.S. tax status, and this really illustrates how different these treaties actually are. Canada, thank God, and the UK have fairly robust treaties that provide a much broader definition of pension, right? And,
yeah, I think it was malpractice on the part of the Australian government, because the last protocol was signed in 2001 and superannuation came in 1992. So really, they should have put in some sort of clause to protect superannuation.
The problem really is here, I think, is that I do not believe when these treaties were negotiated that these other countries understood that by agreeing to the savings clause, what they were really doing was agreeing to allow the U.S. to impose worldwide taxation on their own residents.
Well, yeah, I think also, with when they first put those savings clauses into the treaties, that would have been around the 1930s, right? Citizenship was completely different. I mean, you were a citizen of one country and one country only. Dual citizenship was very rare back then. And so, you know, maybe Australia or whoever, when they put it in, they say, well, if you come over here and live here, but you don't take up citizenship, our citizenship, then, well, let the U.S. do what they want to you. You're still a U.S. citizen. But the world isn't that way anymore. More and more people are dual citizens, and the treaties haven't moved on with the times.
That's right. That is absolutely right. And, you know, and some provide far better protection than others. There's no doubt about that. Do you think that, now, of course, what has really exacerbated this problem is the whole FATCA thing, which is essentially where the IRS has, you know, deputized non-U.S. banks to essentially hunt for people with U.S. indicia, and you know, and then I guess they're free to decide what to do after they're possibly identified. But do you think going forward that countries are willing to put up with this anymore? You know, these savings clause in the treaty and some of this other garbage?
Yeah, I think they should add a citizenship tiebreaker clause to recognize that there are dual citizens, and if you're an Australian citizen living in Australia or an Israeli citizen living in Israel, then you know you should not be subject to you should be able to use that tiebreaker clause to break U.S. tax residence.
Right. So as a further exception to an ongoing savings clause, perhaps.
Yeah.
What are your thoughts on that, Leonard?
That's a very interesting thought, having a tiebreaker clause basically to determine where your tax home is. But then again, the U.S. would be doing away with worldwide taxation to begin with if it were to do that. Because why would it end just to treaty articles that are subject to the savings clause? And I just don't see the U.S., at least currently, being willing to consider that.
Well, you know, I'm not so sure that's true because, you know, I've thought a lot about this, and I'm not sure that my thoughts on this are always right or rational. But it seems to me that the saving clause in the treaty gets the agreement from the other country that it's okay for the U.S. to impose taxation, you know, on these people. I mean, so you get rid of the savings clause, or at least not apply it to the group that we're talking about, the U.S. is still perfectly free to keep its existing internal revenue code, and you know, people can comply or not comply. You know, I mean, we all know that. I think we all would agree here that the statistics strongly suggest the vast majority of U.S. citizens are not filing the taxes. I think.
I think so.
Well, in Israel, that certainly isn't the case because the Israeli banks have become the enforcement arm of the IRS.
But are the Israeli banks
Israeli
or are they just taking Social Security numbers
without making a declaration that they are not a U.S. citizen? Their case is every day I'm writing letter to banks telling them that this individual is compliant with their U.S. tax obligations.
Okay.
So in Israel, it is very difficult. If you want to use a commercial bank in Israel and you're a U.S. citizen, and unless you want to lie when you open up your bank account with the ramification of that here in Israel, you are going to be compliant. So Israel is a country in which FATCA has forced compliance for most U.S. citizens living here.
Yeah, so in Australia, they'll ask you for your Social Security number, but they don't care whether you're compliant or not. The banks don't ask about your compliance, just they want your Social Security number. And then once they've got your Social Security number, it's up to you whether you comply or not.
Well, in Israel, of course, the major Israeli bank, for instance, Bank Leumi, they've all entered non-prosecution agreements with the U.S. government. Bank Mizrahi, Bank Hapoalim, they're currently in negotiating non-prosecution agreements. So the banks here pretty much do have to identify their U.S. citizens, unlike Australia, I would imagine. The banks are under a lot of scrutiny. So compliance is pretty much mandatory for any American who wants to use any sort of commercial bank in Israel. I opened an account recently, and they asked me to send them copies of my FBARs that I filed. So, I mean, it gotten to that extent where I'm turning over my own tax returns and informational return just to open up a bank account.
Can I ask you, Leonard, why in God's name would anybody not renounce U.S. citizenship in this environment? I mean, are most of these people in Israel dual citizens?
Yes, most people are dual citizens, and many have renounced U.S. citizenship. I think it has more to do with an emotional issue. People, they want the security of a U.S. passport. They have
They want the
family in the
security of
United
a
States.
passport that is destroying their lives.
Again, it's an emotional decision. Everybody looks at things differently, but it is more difficult to be a U.S. citizen today living in Israel. And many people, many of my clients who are now former clients have repatriated over the past several years.
Do you mean move back to the United States?
No, I'm sorry, expatriated. They've given up their U.S. citizenship.
Yeah. In the years I've been working on this problem, I think that unless you want to live your life under, U.S. citizenship is a disability if you live outside the United States. Unless you want to live your life with a disability, I think people need to get out of it. I mean, I find it incredible that, somehow, they're not living in the United States. They're a citizen of the country they're living in. I mean, I would have to think that the people who are not renouncing are the people, who can use things like the foreign earned income exclusion and that, to get, to shield all their income or something. I don't know. I mean, it baffles me. There's a lot of people who, at least, from my perspective in Canada, and I've been seeing a lot of this lately, who I think absolutely have to renounce to protect their ability to survive in old age. Here's an example that either I'm now aware of, and so I'm seeing it more clearly, or I've had a lot of this. But let's say you have a U.S. citizen married to a non-citizen, and different countries have their own sort of, the tax systems work in different ways. But in Canada, the principal residence is a form of retirement savings, and you get these people sort of in their 60s. They're married to a non-citizen. If that non-citizen were to die, they would inherit all this stuff and become a covered expatriate, right? So they can't renounce then without paying an exit tax. And they may have to renounce because, let's say you have somebody living in a big expensive home, one spouse dies. Without the income of that spouse, they no longer have the money to pay the upkeep on the house. So they have to sell the house, but then the house is subject to a massive capital gains tax. I think these people have got to get out to, just to protect themselves. And I really do. Okay. Now, we had a lot of questions coming from people, which I'm going to, I think, redefine as loosely the relationship between the role of the tax compliance industry, professional advisors, and the enforcement of U.S. citizenship-based taxation. Generally, the questions revolve around what should individual tax consultants, whoever they may be, or compliance consultants or life consultants, what kind of advice should they be giving somebody who's a U.S. citizen who, learns all of a sudden, that horrible moment where, oh my God, I thought I've been tax compliant my whole life and now I've got this whole problem. What kind of advice would you give? I mean, and so what they do is they'll call up an accountant. I mean, I'm sure you get these calls, Leonard. What do you tell somebody like that?
Well, again, we're all subject to Circular 230, so I am limited in what I can tell them. Obviously we do our best within the rules of the Internal Revenue Code, if possible, to shelter income from at least current taxation. And we inform people that they can give up their U.S. citizenship and what that would involve. I think that's really all that we can, all that we can do.
Do you tell them that you're limited in what you can say to them? Do you say, well, thanks for coming in. Before we start, I've got to tell you that I'm subject to the limitations of Circular 230. Therefore, the advice I'm giving you, has to be limited to such and such a thing. I mean, do you add that or?
Well, I think that it's understood that the advice that I'm giving them is, legal tax advice. I'm not going to tell an American citizen living in Israel just not to pay their taxes or
no,
not.
you can't do that. You can't do that. I mean, I agree with you completely. But can you tell them that you can't tell them anything other than what you're telling them? This came in, there's 5 or 6 questions that are essentially focusing on, she probably saw.
Again, they're coming here for tax advice, for U.S. tax advice. I tell them that I'm certainly sympathetic with them. I'm very much in the same boat, although I am an accountant. I live and work and make my living outside of the United States. I have to worry about 965. I have to worry about GILTI. I have to worry about how my pension fund can be characterized by the United States as to whether they're trusts or other things which could be considered PFICs. I tell them I'm certainly sympathetic of them. We're in the same boat, and I'll do whatever I can within my understanding of the rules of the Internal Revenue Code to limit their tax liability to the U.S. to the biggest extent possible. And that's pretty much what they're expecting to hear when they come to me.
What are your thoughts on that, Karen?
Yeah, so I get emails. I got one today from someone. Oh, my son was born in the U.S. and he wants to buy a medical practice. And I tell them to read before they go to an accountant. I give them some references. Go read and make sure you know what you're getting into before you go to an accountant, because once you go to a U.S. tax preparer, they're going to prepare tax returns for you.
Yeah, I mean, there's a limitation that that Leonard is talking about. I mean, I think it's
totally
terrible.
Well, I would guess tax attorneys may have a little bit more leverage than accountants. I don't know for sure, but no.
Well, I mean, it's a very interesting question, particularly, well, I mean, let's say you take, and we look at lawyers, for example, what about the situation of, say, an Israeli lawyer in Israel, not a member of a U.S. state bar? I mean, I'm not pretending that I know the answer to this question, but it would seem to me that if somebody went to the Israeli lawyer in Israel, that it would be reasonable for that lawyer to say, well, there's nothing about Israeli law that requires compliance with this. It's a matter of U.S. law. Would you go that far with it? There's nothing about Australian law, or do you think that the savings clause in the treaty should be interpreted to mean that there is something about Israeli or Australian law that requires U.S. tax compliance?
I'm not sure I know the answer to your question. There is something within the Israeli tax ordinance, one is not allowed to advise someone to evade taxation in another country as well. That is something that is very particular to the Israeli tax ordinance. Many people, especially what we call U.S. citizens by accident, they go to a bank and now they're forced to sign a W-9. Their parents have been living in Israel for 70 years. They don't consider themselves Americans. They first go to an Israeli attorney. In most cases, the attorney will refer them to a U.S. Tax attorney living here. People are... That's generally what's happening now in Israel.
I assume there must be a lot of U.S. lawyers in Israel.
There are a number of them. There are a number of them.
Yeah, I think this is a gigantic problem. And then, you know, we extend it over to these people who are dual licensed. You know, and say both Canada and the United States, or both Israel and the United States. I wonder if there are conflicting ethical obligations here. You know, I don't know. I don't believe there's anything in Canada that would speak to compliance with foreign tax laws. I believe there is in the UK though. So this, you know, this is another problem. So, geez, I don't know. Maybe part of the lesson here is you know.
Well, and now the entire banking industry in Israel, it depends. Someone has to show that they are compliant with foreign tax laws. So this is something that Israeli attorneys are very sensitive to. I think that maybe in the old day, when the Foreign Account Tax Compliance Act first came around, you know, there were lawyers giving whatever advice they were that they gave. But today, I would be surprised if I heard of an attorney in Israel, dual licensed or not, that would advise someone not to comply, you know, with foreign tax regulations.
Oh, I don't think you'd ever get anybody to advise somebody not to comply. I think that that's pretty much a foregone conclusion. But it does seem to me that that's a different issue from the simple statement that, well, you know, depending on what country you're in, you know, this is a U.S. law, it doesn't apply here. You know, nobody in this country is going to force compliance. I mean, should that be the case? I mean, I think this is a terrible, terrible problem because, and I think that this was really the thrust of a lot of the questions that came in for this particular webinar is, you know, what they're really asking is, can you clarify the role that professionals are playing in enforcing these U.S. territorial tax laws? I think that's really what the question is, right? And, you know, I think the answer you're giving me is it's a pretty big role.
Well, we're definitely preparing tax returns. You know, we're not compelling anyone who walks in my office. I mean, they may feel that they're being compelled because the bank, you know, they have to show that they're compliant in the United States to open bank accounts and stuff. Obviously, if you're a U.S. tax accountant working in a foreign country, you are, you know, working in cooperation.
You're subject to the rules. You're subject to the rules.
You're subject to the rules. That's all. Yeah.
What are your thoughts on this in Australia? But once again, you know, I think that not that I'm suggesting there's a definite answer to these questions, other than the answer that as far as the EAs and CPAs have to comply with Circular 230. But you know, we can see that the answers, I think, sort of shift, you know, depending on where you are. Karen, what's your perception of what's
Yeah,
going on with that in Australia?
I mean, I'm not sure I can answer your question about the legal obligations of an Australian attorney. But I encourage people to try and learn to do as much of it themselves as they can,
So
because
stay away from the professionals, period.
it to the extent that they can. I mean, some people's stuff is just way too complex, but to the extent that you can.
Do you think that you know, the value of staying away from lawyers and accountants is enough to keep, you know, to keep people's lives simple? In other words, you know, if I do this, I'm going to need an accountant or a lawyer, and that's the last person I want to be involved with. So I won't, you know, I won't set up this business or something.
I still think there's a fair number here in Australia who are not compliant. And for those who are not compliant, you know, they're blissfully unaware, a lot of them, of the whole thing. So their bank asks for the Social Security number. You know, they still, you know, nobody's forcing them to comply. Right. And for some, it would be catastrophic trying to comply. If somebody who's already retired.
Oh my God. I mean, you know, it would wipe them out. It would absolutely wipe them out. I mean, think of all the people, you know, basically think of themselves only as Australians or Canadians or something, you know, who have, in Canada, small business corporations are actually, they operate as private pension plans. So, you know, for them to get involved in this means that essentially they have to liquidate their pension plan, right? You know, to comply with this.
Yeah. Yeah, and you get somebody who's got a self-managed super fund over here, and you know, most of the tax professionals are going to treat that as a grantor trust. Look right straight through it, and what are you invested in? And you know, these things may have been built up. So an SMSF can have up to 4 members. You got four members, and you know, 2 of them are near retirement age usually. So you've got big bucks inside the SMSF. I mean, it just becomes a real nightmare.
Wow. And,
you know,
and
there's
if they
no
look
question.
at that as a grant, the compliance with those funds, I can imagine it very difficult and very expensive, even if someone wanted to comply.
Yep, that's right.
There would be 3520 filing requirements.
Yeah.
Probably PFIC.
Probably.
Certainly, trusts are subject to PFIC rules. Certainly, you know, one of the things that we do in our firm with the various Israeli types of pension arrangements to look at it and really make sure that it meets the federal entity rules as to what is a trust. We want to bring it out of PFIC world as much as we can.
Yeah.
You know, look, that's a big part of what we try to do here.
Yeah. Now, you know, you make I think a very important point, Leonard, and you know, for people who are watching this, just because something is called a trust in, say, Australia or Canada or Australia, doesn't make it a trust under U.S. tax law.
Absolutely.
So, yeah. So the first step is, you know, you're not saying directly, you're implying. So let's say it directly. Okay. The first step is I wouldn't even say look. I would say think about and consider, you know, what the proper categorization of this thing would be for U.S. Tax purposes, because, you know, that can make a difference. And one of I mean, I'm not a tax preparer, but I mean, my impression of, you know, looking at this stuff is that a lot of people just say, well, you know, I see the word trust deed in Australia or Canada or something, you know, so therefore, you know, it's a trust. And, you know, I suppose nobody's stopping you from treating it that way, but, you know, to treat it that way, you know, brings along all kinds of expensive, bureaucratic apparatus, right? It is
Absolutely.
a big problem. I mean, I think there's a lot to be said for, Karen's suggestion of the do-it-yourself type of thing. We all are professionals in some way or another, but I think that professionals can be extremely dangerous for Americans abroad, unfortunately, precisely because of these rules. I mean, got to have them, I suppose, in some cases, but I think you got to be careful as well. Do you, just sort of moving towards, I have a message from Mateo and sort of, beginning to wrap this up a little bit. I mean, I think that all of us would agree because, we've been on the front lines of the carnage here, that these are very, very bad laws. Nobody would disagree with that, right? They're unjust, they're immoral. I mean, they're basically imposing not only taxation, but a lifestyle, based on nothing but place of birth. There are many people who can't afford to comply. There are many people who can't afford to renounce, because of the prospect of these exit taxes. I mean, I know what Karen's views are. Would you support the end of this citizenship-based taxation regime, Leonard? Do you think the world would be better if the U.S.
Yes.
moved?
I think that a more equitable tax system would be that someone is only if someone lives residency-based taxation, and of course being taxed if you live in Israel but you have income producing assets in the United States, then of course the United States or any country would have the right to tax income that it generated within its borders, such as with real estate. But yeah, I would support moving away from simply citizen-based taxation, that simply your citizenship is enough to bring you into the tax jurisdiction.
Mm-hmm.
Certainly.
Now, on this point, I don't know, Leonard, how familiar you are with the holding bill, which is in the early stages, but I know Karen is familiar with it. Does that end citizenship-based taxation, Karen? The holding bill?
It moves towards more of a residence-based system, but it's still, the U.S. is still asserting jurisdiction over all citizens everywhere. They're just saying, well, if you live in a foreign country, you can file, once a year with a simple little form that says you're living elsewhere, and they'll tax only your U.S. source income, and not your foreign source income. So it's basically the foreign earned income exclusion extended to all foreign income. But you're still subject to estate tax, gift tax. There's nothing explicitly in the bill that takes away FBAR or any of the other information returns that are supposed to be filed, even if you don't have to file a tax return.
But it does seem to me
there are a lot of internal contradiction in that estate tax. Basically, if I understand this bill correctly, it would be treating a U.S. citizen living in a foreign country as if they were a non-resident alien, taxing them only on U.S. source income. But when it comes to estate taxes, they'd still be subject to estate taxes, even though they're not domiciled in the United States. So, any type of remedy is going to be wrought with internal contradictions, and there's just
it's also the transition rules that they have in there, where any assets that you own, foreign assets, are still taxable when you sell them, the capital gains.
Yeah.
How they're going to police that, I have no idea.
Unless they had some sort of mark-to-market regime, sort of like with the when someone gives up their U.S. residency, for instance, with certain pension plans and other things where you're considered to have a deemed distribution immediately upon expatriation.
Which is unworkable.
It would be horrible. Any way to remedy that would just create further just tax accidents.
Yeah, big problem. I mean, the only real remedy is pure residency-based taxation. And one of the things I find interesting is that, you know, all these varying groups are proposing this and that, but nobody is actually proposing residency-based taxation. You know, I think the holding bill is an excellent start, but make no mistake, it is not an end to citizenship taxation. So I don't know. It may well be that you know, all roads are going to continue to lead to renunciation. And on that note, hello, Matteo.
Hello, everyone. That was exciting. That was very interesting. We unfortunately reached the end of the session, but I know we'll have another session on June 24th, and we'll continue. John, I think you have plenty of material for the next one too, right?
No problem at all.
Excellent.
We can make it a weekly show. The
a weekly show?
Yeah, the Renunciation
there you go.
Chronicles.
There you go. It sounds like a plan. Okay. Well, thank you, Karen. Thank you, John, once again for this very insightful discussion. To everyone who's listening, just some admin issues here to get out of the way. We will have a second session. Same panelists plus Larry, who's going to try to be with us next time around. So we'll have even more voices to hear from. On the same subject, any of the questions that we didn't answer will be answered then. I know there's a lot of material, so as John says, we'll make it a weekly show or something along those lines. If you have any follow-up questions, or if you have any questions that you'd like to answer 3 weeks from now, make sure you post them on the relevant tax-linked forum. Also, if you want your CPD credit, get in touch. I hope you're paying attention, because otherwise we cannot give those to you. So with that said, thank you very much for this great webinar once again, John, Karen, and Leonard. And we will see you in exactly 3 weeks, right?
Yes, thank you very much.
Excellent. Thank you very much.
Nice to meet you. Thanks, Karen.
Thanks, John.
Okay.
Thanks,
Goodbye.
John.
See y'all later. Bye.
See ya.
Bye-bye.